Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Omega Healthcare Investors Inc., ticker symbol OHI. We're looking at Omega Healthcare today as a subscriber request. The business is a real estate investment trust that currently trades for $29.06 per share. Over the last year, their stock price is down 3%. Going back 5 years, the company's stock price is up about 5% overall. Over 10 years, their stock price is compounding at about 1% annually. However, going back prior to the global financial crisis, over the last nearly 18 years, Omega Healthcare stock price is compounding at a rate of 5% annually. Keep in mind that because they're a REIT, they have to pay out 90% of their earnings as dividends to shareholders. So their average dividend yield throughout this time would be in addition to this compounded annual return. And right now, Omega Healthcare has a 9.2% dividend yield. So that's nearly 6 times better than the yield that you'd be getting from an S&P 500 ETF right now. So Omega is trading right between their 52-week high and their 52-week low. There hasn't been a lot of volatility in their stock price throughout the last year. However, right now, a little under 9% of their shares outstanding are currently sold short, and the company has about a $6.8 billion market cap. So for additional background about the business, Omega Healthcare Investors Inc. is a healthcare facility real estate investment trust. Omega's portfolio focuses on long-term healthcare facilities. The company maintains dual goals of increasing its returns to investors while also maintaining a high level of care for residents. Omega works to obtain contractual rent escalations under long-term leases, along with fixed-rate mortgage loans. The company considers merger and acquisition investment as a component of its operational growth strategy. The company invests in the long-term healthcare industry, primarily in skilled nursing and assisted living facilities, and its portfolio of assets is operated by a diverse group of healthcare companies, predominantly in triple net lease structures. Their assets span across all regions within the United States as well as in the United Kingdom. For our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Omega based off of their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public. We're going to be modifying it slightly here to be more applicable for REITs. And I'm not particularly an expert on real estate investment trusts, so again, this really serves as an opportunity to learn in public, and so this analysis will continue to improve and get better over time. With that said, let's get right into today's analysis. Starting things off with metric number 1, for a real estate investment trust, we want their average return on equity to be above 14% over the last 5 years. Omega Healthcare's return on equity has bounced around here. The long-term healthcare industry was significantly impacted by the COVID-19 pandemic, so there's a pretty big drop on their return on equity in 2020. Since then, though, the company's return on equity has rebounded. In 2021, the company produced about 10.5% returns on equity, and that was about the same as what they did over their last 12 months as well. So averaged out throughout this period, the company is earning about a 7% return on equity, which is about half of that benchmark we're looking for, and that's just about what an average public business earns as well. Meaning that this is going to be an X here to start things off for Omega Healthcare. Next up, for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and cash from operations growth for a REIT. We'll be including their last 12 months worth of numbers in our calculations here, and this metric is going to be all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. So over this time, Omega Healthcare has grown their revenue slightly. They're up by about 8%, including their last 12 months worth of numbers. Their earnings, however, have shot up quite dramatically. They're up more than quadruple over this time frame. Most of that is coming from the business improving their operating income, although they did have an asset write-down that impacted their earnings in 2017. So if we were to add in that asset write-down back in, it looks like their earnings would be about doubling over this period. Then finally, for REITs compared to normal businesses, we're looking at their cash from operations, and their cash from operations have increased slightly, about 9% over this time frame. All 3 of these are up here for modest growth for Omega, and this is our first check of the day coming in here on metric number 2. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Omega Healthcare on a per-share basis. So here we're looking for earnings per share growth over the last 5 years. Again, their earnings were up quite significantly in our last metric. However, we still want to take a look at what they've done in terms of their shares outstanding to see if their earnings per share have gone up here. So over this time frame, Omega Healthcare has diluted existing shareholders by about 18%. It's likely that a lot of these shares were issued for acquisitions, as this has been pretty gradual shareholder dilution over this time frame for Omega. So it's not ideal that we're seeing shareholder dilution in a business, because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. And so when a business dilutes existing shareholders by issuing new shares of stock, they're decreasing your ownership percentage in the business, which is ultimately going to decrease the percentage of the business's profits that you're entitled to. So for Omega potentially issuing these shares as part of their acquisitions, this may not be the worst thing if they were able to get more value from those acquisitions than the shares that they were paying. However, some of the worst mistakes that Warren Buffett has ever made in his career came from when he was issuing shares to pay for an acquisition rather than just paying for that acquisition in cash. It's potentially less likely that this would be happening here for a REIT. However, it would still be interesting to see how management is reporting on these acquisitions and whether they have truly added value for existing shareholders or destroyed existing value for shareholders. So that would be something you would want to research more. However, with their earnings growing faster than their shareholder dilution, this is strong earnings per share growth here for Omega. So this is a check here on metric number 3. As over their last 12 months, the company has earned $1.74 for each share that they've had outstanding. Next up, for metric number 4, we're looking for something very similar. So here we're looking for free cash flow per share growth over the past 5 years. So even though their cash from operations and their free cash flow is up slightly throughout this period, their shareholder dilution is actually outpacing this. So over their last 12 months, Omega Healthcare has produced $2.65 worth of free cash flow for each share that they've had outstanding. So that's down about 30 cents from where the company was in 2017 on a per share basis. So this is an X here on metric number 4. So far through our first 4 metrics, we're split evenly for Omega, 2 checks and 2 X's. Next up, for metric number 5, here we're evaluating how the business is utilizing debt. So we don't want to be investing in overly levered businesses, because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. So we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of cash from operations that the business has produced over the last 5 years. So Omega Healthcare has added on to their net debt position throughout this period. Recently, the company has reduced this slightly, and now they have $5.1 billion worth of net debt. However, over their last 5 years, the business has only produced about $3 billion worth of cash from operations. This is coming in less than what they have in terms of their net debt. However, because the business is primarily driven by acquisitions and growth, and for REITs in general, it may be more reasonable to extrapolate their current cash from operations out to see if this is supported or not. Over their last 12 months, the company has produced $630 million worth of cash from operations. So even if we were to extrapolate that out over the next 5 years, that still would just be getting us back to about where they've been at historically here over the last 5 years. So this is going to be an X on metric number 5. Now again, for real estate assets, this may not be as potentially bad of a sign as it would be for some other types of businesses, because the overwhelming amount of this debt position comes from long-term debt that the company has. Real estate assets are able to be levered up more highly than other types of assets, and if their debt is a potential concern for you, you would just want to dig in and understand how it's structured, when it matures, and what rates their debts are at. Again though, through 5 metrics, we have 2 checks and 3 X's for Omega Healthcare. Then our 6th and final metric, the big metric of them all, we want their average cash from operations to their total enterprise value to give us a yield that's above 5%. If this is the case, this will give us a slight risk premium to the yield of the 10-year treasury and potentially offer us a reasonable starting point for evaluation of the business. So we're using their total enterprise value because it takes into account both their market cap and their net debt position, and it's going to give us a perspective of Omega Healthcare that's more similar to as if the business were a private company. So right now, Omega Healthcare has about a $12.1 billion total enterprise value, and we learned that over the last 5 years, the company has produced about $3 billion worth of cash from operations. In an average year, the business is producing about $612 million of average cash from operations. And so when we divide their $612 million of their average cash from operations by their $12.1 billion total enterprise value, that gives us exactly about a 5% average cash from operations to enterprise value yield for the company. That's coming in right at that risk premium we're ideally seeking, meaning that this is a check here on metric number 6, as this is slightly above the yield of the 10-year treasury. Also, when we look at their current cash from operations, in our previous metric, we learned that they produced $630 million of cash from operations over their last 12 months. So when we divide that by their $12.1 billion total enterprise value, that gives us about a 5.2% current cash from operations to enterprise value yield for Omega. So on both a current and an average basis of their cash from operations, it does look like the business is potentially attractive here in comparison to the yield of the 10-year treasury. However, just because this is the case doesn't mean that you're going to run out and go buy the business. This is not financial advice, and this analysis is meant to be taken in holistically. So this is just one of our 6 metrics here, and while these metrics are simple, when they're combined together, they can be very powerful. And we've still got some interesting things to cover for Omega Healthcare. Then as a bonus, here we're taking a look at Omega Healthcare's dividend profile. Again, the company pays out a significantly above average dividend yield of 9.2% currently. And as a REIT, the company has to pay out 90% of their earnings as dividends to shareholders. So here we're looking to see whether the company's dividends have been well supported by their cash flows or not. It looks like the company was able to support their dividend payouts with their cash flows in 3 out of these 5 years. In these other 2 years, they funded themselves in some other way to afford these dividend payouts. But the company's dividend payouts have increased slightly throughout this time frame, even as the company has diluted existing shareholders by issuing about 18% additional shares. Over their last 12 months, it looks like their dividend payouts are slightly outpacing their cash flows, meaning that Omega is split over the past nearly 6 years or so, only supporting their dividends with their cash flows in 3 of these years. If you're potentially interested in this business for its abilities to return cash to shareholders through its dividends, you'd really want to understand how their free cash flows are likely to develop into the future. As the company has kept their dividend payouts the same since 2020, however, their free cash flows are down over their last 12 months, and we'd ideally like to see that these dividends are well supported by their free cash flows, even for REITs that have to pay out 90% of these as dividends. That way we can be confident in how the company is using their financing to be in the long-term best interest of shareholders. So to understand their dividends and their free cash flows in more depth, you'd want to dig into the company's filings and read through their 10K. That'll give you a perspective of the business's operations, and it'll also help you understand how management is approaching capital allocation and what their plans are as it pertains to their dividend payouts. Then everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Omega Healthcare investors, which takes us on to using a discounted cash flow model to come to a potential fair value for the company. So a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So here we're starting with their current free cash flows and using historical growth assumptions for how the business has grown these free cash flows dating back all the way till 1992, so over the past 30 years, to be able to project these out into the future. These are historical growth assumptions that it's up to you to do the work on to determine whether or not these are going to be potentially accurate and applicable going forward over the next 20 years to give us a baseline projected estimate for the business. If we assume that the business's cash flows decline at a rate of 3% annually for the next 10 years, and then we assume a terminal stage for the 10 years out after that, where these free cash flows decline at a rate of 6% annually, if we add in the company's tangible book value, which gives us an approximation of the tangible assets that the company has per share, and we were ideally seeking a 15% rate of return from the business, which is the rate of return that Warren Buffett is ideally seeking from his investments, then it looks like a potential intrinsic value for Omega Healthcare investors is right around $26 per share. That's just slightly down from what their current stock price is. However, even on top of that, you'd likely want to get a margin of safety for a business, especially if they would potentially have shrinking free cash flows into the future. That may or may not be the case for this business going forward, but that's how the historical trends for this company have gone. There are also a couple of caveats to keep in mind here. One is that a discounted cash flow model really works based off of the overall predictability and reliability of a business's future free cash flows. That's not necessarily been the case for this business throughout the past. And so there are reasons why it may be more difficult to assess the predictability of this business's future free cash flows than in comparison to some other types of businesses. Another caveat you'll want to be mindful of is that this 15% rate of return would be including their dividend yield. So 9.2% of this would be coming from their dividends paid to shareholders currently, and their stock price looks like it would only be appreciating by about 6% annually over the next 20 years if this were the case for the company. So finally, it's worth being mindful that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in summary, Omega Healthcare Investors checks the box on 3 out of 6 of our metrics. They're earning about average returns on equity. However, that has improved since 2020, with the business earning about 10.5% returns on equity over their last 12 months. The business has grown their revenues, earnings, and their cash from operations over the past 5 years. However, they've diluted existing shareholders, likely for acquisitions, by about 18% pretty steadily throughout this period. The company also looks like it's using a fair amount of debt, especially relative to their cash from operations. This may or may not be a potential concern given the nature of their business, but you can dig in and learn more if that's an issue for you. Looking at their average and their current cash from operations to their enterprise value and comparing that to the yield of the 10-year treasury, it does look like the business would be potentially attractive relative to the yield of the 10-year treasury, and that the company would be offering a potentially slight risk premium. So that's just saying that the business may be potentially interesting to dig into and learn more about. Then the company pays out a significantly above average 9.2% dividend yield, and it looks like the company has supported that dividend in 3 of the past 6 years with their free cash flows. But just like any other REIT, their dividend payouts are going to be dependent on their free cash flows going forward, and it looks like their dividend payouts per share have been flat since 2020. Then finally, performing a discounted cash flow analysis of Omega Healthcare investors. If you've done the work and you believe that those historical growth assumptions are going to be accurate and applicable for the business going forward, and you are ideally seeking a 15% rate of return from the company over the next 20 years, then it looks like a potentially fair intrinsic value for Omega Healthcare investors is right around $26 per share. So that's just slightly down from what their current stock price is. However, depending on the durable competitive strengths of a business, you'd ideally still want a margin of safety on top of that, and that's assuming that the business would maintain its current multiples. So there are reasons why that may not be potentially accurate for the business going forward, so it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about Omega Healthcare investors. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $119. That's just 33 cents per day through my referral link down in the description below. Normally premium is $239, but if you use my link, it's 50% off. So check it out if you're interested. So as a value investor, you're ultimately trying to conduct this research as if you're going to own 100% of a business, and you can truly understand the ins and outs of that company and understand what's important and what's not important for the company going forward, ultimately learning the underlying essence of the business. Through this deeper research, you'll learn more about the qualitative and the quantitative aspects of Omega Healthcare, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of Omega Healthcare Investors Inc., ticker symbol OHI. Again, we looked at the business as a subscriber request today, so I'm happy to make an analysis of the company. And if you enjoyed the video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what company you want me to take a look at next time. Thanks for learning about Omega Healthcare with me, and have a great day.